Welcome to another episode of the Market Pulse podcast. I'm your host, Matthew Pohl, and we have quite a lineup for this week in regards to the financial markets. So let me give you a quick overview before we dive in, and then we'll get our disclosures out of the way. So we've got a lot of topics, some to include the SPF sentence that just happened this week. We're going to talk a little bit about the DJT SPAC that Donald Trump just put out and the massive value that's compared to Reddit, even though revenues are nothing close to Reddit's revenues. We're going to talk a little bit about the national debt spiral that's occurring right now. And last but not least, you guys probably caught this, but the surge in cocoa. So if you're a chocolate fan, this might be something that highly impacts you. And then we'll get into my favorite part where we do some trades at the end. I'll show you my outlook for the next week on the S&P 500 and on gold. And I'll give you my recap from the previous week also, so you can hold me to our technical analysis that we did the previous week. So got a lot to unpackage here today. Let's go ahead and jump in. So let's go ahead and jump in, guys. Let me start off. We're going to go in. I'm going to pull up my notes here. I've got quite a list.
Breaking news.
What you're about to see may disturb you.
But we're going to go into this snooze you lose section where SPF is sentenced to 25 years in prison. And for those of you who do not know who SPF is, in fact, I tried doing this thing on Dolly where I asked it to make a image of SPF and it wouldn't do it. Dolly now has a bias towards specific characters, which I don't know if I'm particularly a fan or not a fan of, especially when it comes, I get the whole deep fake problem. But here's a recent picture from SPF being escorted out of the court office. And this is quite a debacle. Let me unpackage this for you, for those of you who may not be caught up on what's happened. And we'll talk about the uniqueness of this trial, sentencing, and kind of a silver lining that came with this SPF sentencing. So SPF was just sentenced to 25 years in prison for the FTX collapse, where customers lost somewhere around $8 billion and investors lost somewhere close to $1.7 billion and lenders at $1.3 billion. Now, this is obviously nothing like the Madoff scandal in terms of numbers, and it kind of ends on a good note, which we'll talk about in just a minute. But federal prosecutors thought and were really seeking about 40 to 50 years. So to see this 25-year sentence was kind of a slap in the face, but it might have had something to do with the likelihood that there would be full restitution for those customers where the assets got allocated to the wrong places. So Judge Kaplan highlighted SPF's lack of remorse also in the courtroom, which might be connected to some of the drug use that was tied in this case. He also talked about his lack of awareness and, frankly, his neglect and admittance towards criminal actions that he knew he was doing and did anyways. And so despite the crimes, SPF made some successful investments. And that's what kind of it sniffs and smells a lot like the old Madoff case, where Bernie Madoff and the Ponzi that he did years ago, and there's been so much talk and conversations and movies and shows about this, is really an interesting one in that he had a viable business before he started his scandal, before he started getting so greedy. And we're kind of seeing the same thing with SPF. These characters are really unique. They have obviously a skill set and an ability to run and do something legitimate. Even if the investments weren't good, you could still do it legally. But what makes this case really unique is SPF made two really successful investments. One in Anthropic and Solana. And Solana was one of the big wins for them. But they're estimating, based on the value of Anthropic and Solana, that there's going to be full restitution to all the customers' money that got sent overseas and sent over to Alameda, and was frankly just lost, stolen from customers. They're also saying that it will likely bring restitution to all the investors. Now, they haven't spoken to the lender section of this, which obviously, if I was a lender, I'd be a little concerned about this, but I think that is the order to things. They're going to first pay back the customers' accounts that were stolen from. Then they'll go to the investors, and there may be a buy up, meaning they'll get actually more than what they had in terms of their ownership in FTX. And then I'm not sure, I've not heard what they're doing with the lenders. I would imagine that they would be equal to the investors in terms of timing on restitution, but I haven't heard anything on the lender side. So be curious to see how this rolls out. Obviously, this is based on current prices, current market value for Anthropic and Solana. Obviously, if something radical shifts there in the crypto market, takes a massive dive, there may be some issues with that. But as of right now, restitution can be made, and it really throws this kind of weird silver lining over the whole thing, that like SPF kind of knew what he was doing, but then got really greedy and just thought he was above the law. And there was a lot of discussion about this kind of effective altruism that he was running under. That like, well, you know, this Robin Hood effect, like, oh, we're going to steal from the rich and give it all back to the poor. And, you know, we're not going to make any money and give it all away. Like this kind of conversation or talk, I think, enabled him to think that he was above the law. And you know, frankly, we're seeing the repercussions of that. Even though I will say that going from a 50-year to 25-year sentence is a massive drop. So he will likely not be spending the rest of his life in prison. And there was nothing also, I don't know this, and I'd be curious to hear your guys' comments on this, but there hasn't been a lot of talk on parole and if parole is possible and how soon parole is available. I think it's going to piss off a lot of people if we see SPF get out in the next 5 years on parole. But on the other side, it's like, how can you be mad if you're a customer and you got all your money back? So I don't know. It's kind of this torn idea. So we'll see. Trump is at it again. And this time, he's got what some are calling a meme stock. It's Trump's SPAC. It's called I believe it's the DJT, the DJT SPAC. And we've got to talk about this because it's kind of mind-blowing. But the DJ SPAC is being compared to there's a lot of conversations around Reddit around this. And here's the reason why. This DJT, if you go look it up on the news, you know, obviously probably leaning more progressive than conservative, is out to attack Trump. And so they have nothing good to say about this stock anyways, or this SPAC anyways. And have done a lot to try to even hold it back, using the SEC as kind of a weapon. But Trump's SPAC was just valued at $8.5 billion. $8.5 billion. And to a lot of you, you'd go, well, that's not very much. You know, the guy's already worth billions. No, like he got fined 500 million. And this is definitely I would say there's a lot of political play in this whole thing. But he just got fined 500 million. And I think the left or progressives really felt like they got an arm up on Trump when this happened. And then he goes out and does the SPAC and gets an insane overvaluation. And let me show you how insane this overvaluation is and some reasons why I actually wouldn't short it or bet against it. Now, $8.5 billion is the valuation, 4.5 million in revenue with a $500 million loss tacked onto it. Now, why is this similar to Reddit? Because Reddit is valued right at about the same amount, 8.5 billion. You want to know the difference? $800 million in revenue. 800 million versus 4.5. See the difference? And so, I mean, if you were to value anything, this is maybe with Trump's brand on it, maybe worth 100 to 200 million, maybe from a pure valuation standpoint, half of that. But tying his name to it as a meme stock or as a vote, so to speak, for the Trump name and Trump brand going in the future, that could be a big deal. But the problem is that there's not a lot tied into this. I looked into this, and there's not a lot in this SPAC. There's not a lot tied to this conglomerate of Trump's work. And he's not promising everything in his future also. And he's not promising his brand is going to roll things out. Now, I have some speculation on this, on what I think will happen. But let me get through the rest of the details. So the valuation on this, obviously with a massive market value, our total market cap value, is clearly a populist support for Trump. People are looking for where to put the money, where to put things. The GOP, has been under raising funds. The Democrats have been, outpacing the Republicans in terms of the next presidential race. And then this happens. And frankly, it's a vote for Trump. I don't know how else to say it. It's a bet on Trump. And I think what people are betting on, I would even call it a protest Trump. Like, people are so pissed that they're like putting in their money on as a protest against the perceived persecution of Trump. And this bet is enormous. It's bigger than any political donation that's happened. And it's not even political. Trump, in 6 months, I believe, don't hold me to that with SPACs, but in 6 months could start selling out his shares. And so this leads to my next point. What I think will happen is, even though the media hates it, even though there's so much negative news around this, which I think actually fuels this protest vote against Trump. Like, every negative news article is like another dollar into this SPAC, and they don't get it. But what I think is going to happen is we're going to get closer to the election, closer to the time that Trump can take the money out, and then he's going to come out with a huge announcement, something about all of his future work going into this SPAC, or something about his name being tied to it forever, or his brand being tied to it in some unique way, or if I win this election, I'm going to make all of my assets from here going forward into this SPAC. I don't know. He's likely going to come up with something that's going to rise the market cap even higher. And all that was speculation, by the way, but my guess would he'd do something to rise the market cap higher so that when he makes a massive exit, it keeps and stabilizes market cap so that he gets an incredible price for the value of what he's put together. And what does this spell out for people like you and me? Massive opportunity also, meaning that if you are believing or you're hearing what I'm saying, the climb is not over. Do I think that this is actually valued at this? Absolutely not. That's where the huge risk comes in, and there are people that are looking for ways to short this right now because of this. But do I think it will have higher highs? Yes, I think we're in the growth phase, and there's going to be a surprise. There's going to be something that he announces that's going to create more support for this, but may not actually rise the price. It might stabilize the price for a strong exit, meaning it would rise the price, but with him exiting on his shares, it's going to stabilize the price. And so a lot of people are comparing this to the Bowie Bond. I don't know if you guys recall the Bowie Bond way back in the day. This is way before my time even. But the Bowie Bond was one of the first kind of celebrity, let's create a future loan or a future credit or a future investment in me based on some work that I'm going to do in the future. And the Bowie Bond was all about investing in Bowie as a person on future work he was going to do. He basically said, if you put up this bond and I raise X amount of millions of dollars, every song that I put out from here on out, or every song that I put out from the past, is what I think he did, will be part of this bond, and it'll go to pay back the lenders, or in this case, the borrowers, or the borrower side of this bond. And I think Trump is doing the same thing. One, yes, I think there's definitely some political leverage that's helping this a ton. But two, he's really leveraging his brand. And I think that this reflects that there's been a major shift in fundamental base trading, this value trading that Warren Buffett used to speak of so highly. I think that is really going away right now. And because of how much cash is in the system, speculative trading and betting on individuals, betting on brands, betting on names is really kind of the next new thing. So there you go. There's the Trump Reddit comparison. It'll be fun to watch that one. I will be honest, I am not placing any bets in that one. I think that's a pretty high risk. There's going to be a lot of volatility and probably a lot of news that's going to be hard to decipher what's the truth of around that. Now, but Biden just came out with his budget plan for 2025. And frankly, I am kind of shocked. I mean, I don't know how else to say this, but I'm kind of shocked at the lack of coverage and interest that this country has around our budget. It's getting ridiculous, and I don't understand how we're not holding our public elected officials accountable for spending. It's affecting all of us. All of us are going to the gas pump. We're going to buy our cartons of eggs. We're trying to make rent. And this is like an everyday pain, but it seems like the population is like a frog slowly boiled in water. Like it just doesn't know that it's boiling right now. It doesn't know how painful it is because the acceleration of debt has happened so slowly and secretly in a way that we're just numb to the pain. We're numb to how bad inflation has been. And I'm just shocked at Biden's 2025 budget plan. I am shocked that he is not getting ridiculed for this, and that the main topic for this next election isn't how we get this country under control when it comes to national debt. Having said that, I want to bring up some charts that emphasize my point, and also give you the data, because I don't like just talking about things and not actually showing you like where this opinion and viewpoint comes from. So here is the first chart I want to show you. And this is the government debt from 2021. We don't have anything more recent than that in terms of percentage of GDP. And this shows us how we're ranked percentage of GDP as a country to all other countries. And you can see we're the chart in red. And we're like, you can obviously see that Canada is doing a better job than us. Australia, Hungary, Finland, Germany, Poland, all of these guys, Ireland, Iceland, all of these countries are they're creating more GDP as a percentage as a country, and everything to the right is doing less. And so what does this chart actually reflect? What does this chart actually mean? It shows as a country, one, that we're definitely above average when it comes to debt to GDP, like how much national debt we have in correlation to the amount of GDP we're getting out. Because if you don't have a high level of GDP, you can't afford to pay for these loans. You can't afford to keep up with the bonds. You have to print more money to pay the bonds, which causes inflation. This is the problem we've been dealing with. But on the right, you can see that Japan leads the way at 241, and it makes this ridiculous argument that politicians continue to use, and it will likely not change things for a very long time, because they can go, well, if we're at 141 and Japan's at 241 and they're doing just fine, we can print a lot more money and still get away with it. And so the problem with this chart is that it gives politicians the leeway. The interpretation can often be that we are doing just fine when you compare us to everyone else. So there's kind of the lipstick on a pig chart. Let me show you the charts that scare me. This is a chart that shows US surplus over deficit by year in billions. The deficit, meaning we are not covering our bills year after year after year. And you can see after Clinton, which, by the way, I will give Clinton that he had our budget down better than any president, I think, in my lifetime. And you could see that we were above surplus in 2000 and 2001. And then after that, we have been in a deficit since 2001, guys. That's 23 years. And in 2020, we hit COVID, and we went from like a negative 1,000 to 1, 2, 3 times the normal amount of deficit in this country. The next year, we tapered off of that. 2022 was kind of a rough year. You guys remember how that looked. And we pulled things kind of back to normal, but still in like the highs, like a lot of deficit, like 2009, 2008. This was during, if you guys remember, the real estate crash, the last recession that we had. And now we're climbing back. And the projection going forward is that this is the new norm, that our country is just going to get normalized at this new deficit, this new level of spending. So how do you fix this? Well, you either cut costs, the cost of government, or you raise taxes. Now, if you work for the government, you're not going to like what I'm saying here. And by the way, about 50% of people are either subsidized and or work for the government in this country now, which is an astronomical number, especially if the amount of government subsidies creating employees, the amount of GDP they create is significantly less than the public market. It just means we're going to get less GDP out, which means deficits are going to continue to grow. On the other side, more taxes. Who here feels like more taxes is the answer? And if you think for one moment that those taxes aren't going to come out of average middle-class America, you are insanely wrong. That's where most of those taxes will come from. And we've got to start shifting what is important to us when we're picking our presidential candidates, and not just them. I would say all elected officials. This should be the topic of conversation in this country right now, and it's not. It's barely being talked about. And what we just created as a new norm, it ends one way, guys. It ends in our currency hyperinflating at some point. You guys heard me last week talk about how Social Security is positioned to dry up in 10 years. You think they're just going to make that disappear? You think they're going to print more money to fix that problem? They had to push the retirement age up. These are all repercussions of our votes to our elected officials. And the fact that this is not one of the main conversations, I mean, it's just driving me nuts, if you can't tell. Here's another fun one. This is the annual US budget projections from 2005, 2015 to now 2025. So they're saying, here's where it was in 2025. This is what we're predicting. And this almost makes me sick. Social Security from 2015 to 2025, that's 10 years, is positioned to double in cost. So if you're wondering, like, where are all these expenses coming from? How are we going into more deficit? And frankly, how is it going to get worse? Well, here's one of the ways. If you look at Medicare, Medicare is positioned to double over the next by 2025 from 2015. Now, if you look at defense has grown, but it's probably the best chart on here. It's grown the least. So when people fight and they say, well, we're spending too much in defense, the military industrial complex keeps growing, blah, blah, blah. It's like, that's not where we're seeing the most growth. Then we have, what is this? I got to look at this. Oh, we have non-defense. So we have non-defense expenditures. That's more than doubled. Then we have, this is so small. Oh, net interest on debt. This is the one that scares me the most. Our net interest in debt has almost more than tripled over the last 10 years. This is the interest payments on our debt issued. So when we borrow, essentially, we sell these bonds, we have to pay interest on that. Well, if we don't have a lot of GDP and we're having to raise the interest on it to make them attractive for buyers, that makes the expense much higher. And it is more than tripled in the last 10 years. And if you think, this is how this cycle works, guys. If you have to print money to pay your interest payments, and printing the money causes more inflation, inflation causes the devaluing of the currency, devaluing of the currency forces you to raise your interest rates so people are attracted to buying the bonds. This spiral just keeps going like this. And so I wouldn't be surprised if 2035 projections for this bar here double, at least double, meaning that this will be our payment on interests for our national debt is probably going to be the area that grows the fastest over the next 10 years. And then we have our deficit, which has grown, I would say, almost triple in the last 10 years, which means, guys, we're just overspending. And like when you start, and you keep hearing these trillion-dollar numbers that are getting thrown around budgets, this is insane. Like, it's not sustainable. All right, I'm going to end on this note, on this topic. And this is federal receipts as a percentage of GDP. This is provided by Fred. And what this governs, or what this shows, is the government's total tax revenue to the country's economic output. So total tax revenue in relationship to GDP, in relationship to economic output. And so the equation's right here. So the federal receipts as a percent of GDP equals total federal receipts over GDP times 100. And then you get this chart. I'm going to point out two things on this chart. And let me just zoom in a little bit so you can see this a little better. Two things on this chart that concern me is almost every time we've had a decline in the percentage of GDP, we've had a recession. Here, the turn recession, sharper turn recession, 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 turn, lag, COVID recession, hard turn. And so in my mind, I don't see how we don't continue to follow these patterns. But more concerning, it brings up once again, how are we going to pay these bills? And more importantly, there's a correlation between, there's like this hot spot for the economy to get the most out of the economy in terms of taxation. And when you start overtaxing to pay the bills, you actually destimulate the economy to where production actually stifles. And that's what we're seeing here in this chart, is that there's a stifling happening in GDP in correlation with the federal receipts. And so what we need to do is we need to find this balance. We need to make sure we're still stimulating the economy properly, while not we got to find a solution to not overtax somehow, while also paying our taxes so that we can keep our national deficit down. And really, if I were to put my finger on this, guys, I would say that the solution is that we need to get someone in with a very sharp pencil to start cutting our budget way down. And it may be at the cost of a lot of government employees going back out into the public market where, frankly, we get more GDP. The old saying is, give the government a job that the public could do, and it'll take them twice as long, cost twice as much. And this is kind of a pattern we see. The public market, the open market, does things more efficiently and better because it's competitive. And as soon as you take that competitive nature out, costs go up, the expense to get things done go up. And frankly, what have we seen in this country where that hasn't happened? Where the government takes over a certain role. Medical, the moment government started going in and saying, we're going to start socializing medicine, we're going to start making this for everyone, but it's going to be under our umbrella and we're going to oversee it. Medical costs have been going through the roof. I mean, just look at your bill. The more the government steps in on medical, the higher the bill has become. Look at it for anything that they step into. The cost of the goods start to go up. The efficiency to get the cost or the good out goes down. And so it makes a strong argument, guys, for the open market and really for the government to take this moment and for people to take this moment and go, does this really work for me? Does it work for me to have the government be more involved in everything that I do in my life? Or is this an opportunity for us to go, let's scale things back. Let's get this country back on its feet. Let's get inflation down to where it used to be, and let's stop penalizing our hardworking Americans that are frankly tired and broken. All right, what do we have left? We're going to talk about cocoa. And cocoa prices have been skyrocketing, guys, and we're talking like 10x. And the cocoa price hits this record because El Nino came through, and because of the excessive moisture, this fungus started hurting the crops like on an incredible level, like more than a 50% reduction in crop yields in some areas. And so what has this done to supply? Well, supply has gotten really limited. And there are people that are saying that it could get so bad that chocolate may become a luxury good. It may become so expensive that we can't put, I mean, give these things time, give them years, and the market will correct. But over the next couple of years, chocolate might be really expensive. So you might, if you're a chocolate lover, you might go to the store and stock up while the prices are low. They will not stay in this place because the cost of cocoa has done almost a 10x. Now, that is something that you can trade. That does exist on the futures market as a commodity you can trade. And there are also many stocks in the cocoa business that you can get on. All right, so let's go into my favorite part.
You ever wonder why fund managers can't beat the S&P 500? Because they're sheep. And sheep get slaughtered.
And let's talk about gold. So here's our gold chart. And you can see clearly from the last time we checked in, kind of our angle and approach where we thought things would go. I've been quite bullish on this and we've talked about this also, but we finally had a breakout in this channel. And so we're gonna have to talk a little bit about that. But we talked about the price kind of staying in this region over here. Last Thursday was, what was the date on last Thursday? Let me check really quick, guys. So the 29th. Just go back a week. 29th. So 28th was the last time I did this. I just want to make sure that I get all my charts up the right way and we're marking things the right way. So this was the last time we checked in. And if you guys remember, I've got to remember to save my drawings. But if you remember, I was bullish. We talked about staying in this region between the support and resistance. We actually changed this color. I'm going to do that again here. Change this to be green. We can change this now to be green. And there we go. And we had a breakout also. But if you guys remember, we called out last week to be within this region. We said bullish versus bearish, even though we were at the top of the chart. We said you could try to position going short, but we were really hoping that it would come back down to this 2200 level and we'd get a buy-in option. But then Monday happened as a holiday, and Tuesday, things just skyrocketed after that. And so we are definitely out of this channel. Again, fundamentally, you guys know my view on gold. Fundamentally, I'm very bullish on gold. And the banks, that actually countries right now, are stockpiling gold as we speak as a hedge against currency devaluation. And I think individuals are also. They're saying, I want to put my money somewhere where I just know I'm not going to lose value. And gold, 1 ounce of gold is worth 1 ounce of gold. And how much you need to make a microprocessing chip or to put in a cell phone, you still need that amount of gold to do that, aside from it being a precious metal. So this is today's market. We're going to go in now and adjust a lot of these tools. So I'm going to go in and delete these. I'm going to delete my channel, and let's get a new channel in, as the slope of this has radically changed. So I'm going to say we're in here somewhere. We're going to back it up. Yep. Swing this up a hair. There's our new channel. Gosh, the slope on this, guys, it's intimidating. No wonder we're having a red candle today, by the way. I mean, this, dang it. Let's see if I can bring that back. Just trying to clean these charts up. Let's get that back in. Nope, that's not what we want. That's what we want. I actually like this better. Wow, the slope, though, is incredible on this. All right, so let's go through the technicals. We do not have a price ever that compares to this. And so when it comes to support and resistance, you guys know the rules. It's rounded numbers. You can see clearly why we're hitting and stopping here. We're at the 2300 level. So obviously our next stopping point is going to be around the 2400. Maybe 2350. We'll get some slowdown. I'll mark it, but we'll put it in light. So I'm going to make the color a little lighter. And we'll make it a little thinner too, so that you guys know what we're doing here. By the way, you guys are welcome to take screenshots of this as we go. Let's get it all positioned first. Go green, green, green. I like this. There's a support and resistance. 22. And so this makes a strong argument that you may have some resistance going into today, into this region here. It's a little big for me. I'm going to say more here. And then going forward, you just have this strong argument for a breakout. Edit. Turn this into a 3. And then there's like a 2 possibility also for it to live down here. And this is going to be more likely. This is going to be less likely as of today. So I'm going to make that smaller, make this bigger. And that's because we're between the support and resistance level. That's just what's so. The likelihood of us going, and I'm actually going to put this over to, it's really here. And then up here is secondary. The likelihood of this going down is actually greater because of the 3,300 price level, and then a bounce off the 2250 based on it being a rounded number and some support and resistance we're seeing in the last prices. It's more likely next 2 days to go here. So Friday morning, wake up, there's likely going to be some candle or wick in this price. And then secondary, I'm still bullish on this. We're eventually going to end up in this price zone, especially the way that countries' currencies are devaluing. It's not just the US. We're seeing countries' currency devaluings in like upwards 50% in some countries. And so it's not just impact from the US, it's impact around the world. And the world, I think this is why we're also seeing a lot of growth in Bitcoin. The world is looking to hedge their bets into something that doesn't lose its value, like gold or Bitcoin. All right, let's save this so I don't lose this for next time. Let's go into S&P 500. Hopefully this one got changed. It's like sometimes they get saved, sometimes they don't, and that's my mistake. It's not anything else. All right, it was the 28th. Okay, here's our last week. Get rid of this. Whoops. Let's get rid of these. Channel, we're going to have to adjust a little bit. And this was pretty consistent to what we were saying last week. We had the channel. We really liked the channel. We said that if it came down into this region, that a likely bounce towards the center would be likely. We had the 5,300 level as pretty strong resistance. And so now we're kind of in this sideways movement. And I'm going to adjust some of the support levels here. But this was unexpected. This breakout here was unexpected. And it just is a day-to-day thing. You know, you wake up Monday, it's like, oh, awesome. We nailed where the price would go. And then Tuesday came in with some bad fundamentals. The VIX rose quite a bit and the S&P 500 kind of took a dump. So going forward, one, we're going to need to adjust our channel. We're going to open it up a little bit. That looks okay. Okay, we're still alive in this thing. There's not a clear breakout yet. You could argue that it broke here, but the fact that it's tracing back in is going to make the argument for this channel just widening a little bit. Still makes the argument of being bullish. We are at higher highs than we were last week. And we're at the bottom of the channel. And so this I like. And this is what I would do for the next 2 days, is look for some positioning into this price zone here, where bullish yet conservative to 5,300. Obviously, if it comes back down into this channel, a good buy-up opportunity would exist. And then after that, I'm going to kind of circle the center of the channel as my no risk zone. So I'm going to say, just from a technical standpoint, the risk is the least in this zone here. I'm going to put this secondary where the price has been. And this is just a low risk option to be in the center of the channel, but very cautious of this resistance level. It's very likely to bounce off of this. I'm going to draw one more circle to show the more likely area is here and here. But it could go up into this region, but in the center, and probably isn't going to test the high of this channel. So that's our S&P 500. For both, bullish seems to be the call, and I've been saying bullish on gold and the S&P 500, guys. It seems like for weeks, but that's more of a fundamental view. There's just so much cash out there, guys. It's hard to argue that the price from a speculative point won't continue to go up. It's not a value thing going on right now. These stocks are highly overvalued, priced to perfection with no room for error. And so this is speculative trading. This is trading coming out of money market accounts. And the first time the Feds raise rates, I would expect more money to be dumping into these markets as people won't be able to get the return that they're used to. I've even seen 5.25% returns on these high savings accounts, high yield savings accounts. And it's like when that starts to tick down 1 to 2%, people will start moving their money back into the markets. And there is a lot of money sitting in those side accounts right now. So that is it. That wraps things up. I am going to miss you, and I always enjoy our time here on the Market Pulse podcast. And if you guys have any thoughts or comments on what you'd like to hear me talk about, always feel free to chime those in the comments section, or you can reach out to me directly on my website. But that wraps up my time with you today. You guys have a great rest of your week, a great trading week, and we will see you same time, same place next week.